In this video, I will discuss 5 stocks to play option on it for the second half of 2024. These stocks have high implied volatility, while I don't mind personally owning these stocks in case the stocks went down and we end up getting a sign on any of the cash secure put or the credit spread that we will be selling on it. Let's dive in. The first half of 2024 have been absolutely amazing for me. As you can see, my account have went up by 20%, which accumulated to 61,826. Let's take a look at the averages. The S&P 500 have went up year to date 15%, while the Nasdaq have been the biggest by going up 19%. And finally, the Dow Jones Industrial Average has went up 3.72%. To take a quick look at the performance of the 500 companies in the S&P, we come here to the S&P map and we change the performance from one day to the year to date, and you will see here the individual companies and how much they went up or down during the past 6 months. The first stock on the list is Tesla. Playing options on Tesla stocks has been profitable for me for the past several years. You can see the stock for the year to date have went down from the 250 all the way down close to 142 before a rebound to 197. Let me scroll down to show you my position. Currently, I have 4 option strategies on it. I'm selling the put for 170, 175. I have a poor man cover call, and I have a 3-point credit spread until the end of the year. The unrealized total return is about 2,987. Let's go ahead and go to the trade Tesla options. If we went to the Tesla option and change it to August 16, which is about a month and a half from now, and change this to put and sell, currently the 185 strike has a delta of 31, which is the closest to 30 compared to the other, because if we went down to the 180, you will see the delta is at 26. To sell cash secure put or a put credit spread with a high probability of winning, I always recommend going for a delta of 30 or a delta of 20. A delta of 30 or closest to 30 will be the strike for 185 here, while the closest delta to 20 is the 175 strike with a delta of 22. You receive different amount of credit for each strike depending on the risk we are taking. The delta not only represent the movement in the option price for each dollar the stock change, it also represents the percentages that this option might expire in the money. For a delta of 31, meaning there's a 31% that the stocks will drop down and this option will expire in the money, meaning it might get exercised on us. Similar thing for the 175, clearly because it's a lower strike price, then it will have a lower percentage of ending up in the money. In this case is a 22. Because we are taking a lower risk, we are going to collect a lower premium comparing to the 185. In this case, we are receiving 868 divided by the collateral, which is 185, resulting in 4.69% for a month and a half. So if we divide that by 1.5, it will give us a final result of 3.12% return on our cash investment, or in this case is going to be a cash collateral for each month. Clearly, it's a very high return, and it's all thanks to the implied volatility of Tesla stocks. Even selling the 175 will generate a great return for us. If we came here and we divided the 538 divided on the 175, that will result in 3% return divided on 1.5. That will give us the monthly return of 2%. Of course, that's still amazing, since if you multiply that by 12, that will be a 24.5% per year. Absolutely great. If we want a little bit more stable return, we probably go further in dates. In this case, I chose the October 18, which is 110 days to expiration, almost 4 months. The closest 30 delta is the strike of 180 with a delta of 29. If we scroll down, we also have the 165 strike with a delta of 19.95, which is the closest to 20 in this case. Let's check the return of each of them. The 180, so 1195 divided on 180, the cash collateral will result in 6.63% return. Divide that on 4 months, that will give us the monthly return of 1.65. The return is lower comparing to selling cash secure put for a month and a half. However, this will give us a more consistent, stable return, since if the stock really shot up high or low during a month and a half, we won't be able to sell another cash secure put with the same strike and collect the same credit. So it's really a risk reward balance between going further in date and collecting a smaller return, or taking a bigger risk in the short term and collecting a higher return. If we went down to the 165, we are going to collect about 708 credit. Divide that on the 165 cash collateral, and that will result in 4.2. Divide that on 4 months, it will generate a monthly return of a little bit above 1% per month. In both these scenarios, we have a high protection to the downside. As you can see, the stocks here has to go down 15% for us to break even. So if we press on it and we see the graph here, let me remove my camera. So you can see here the graph, the stocks can go down 9% by October 18, and we still collect the full profit for this trade, which is the premium we collect, 1,195. The stock will have to go down 15% for us to break even, meaning the stock will be at 168.05. After that is when we are start to losing money. Same thing for the 165. If we took a look at the chart, here we will have a bigger protection to the downside. The stock can go down all the way 16.5%, and we still will collect the full profit for this trade. The stock will have to go down under 20% before we start losing money. To raise the percentage return on our cash collateral, I would advise you to sell a put credit spread, meaning we will sell the 180 in this case, but we will simultaneously buy something like the 150. So if you see here, this is the detail for the 150, and you see this trade will change. Now we are risking a maximum of $30 per share, or 3,000 per contract, which is the difference between the 180 and the 150. That will generate an $8 per share, or 807 per contract to be exact. The stocks can go down all the way to 180, and we will still collect our full profit from this trade. Our break even will be minus 13% from the current price, and then the maximum losses when the stocks drop under 150, which is about minus 24% from the current price. But the benefit of the put credit spread, in this case, we are collecting a slightly lower premium, which is 807. But if we divide that on the 3,000 cash collateral, it will result in a 26.9% return. Divide that on 4 months. That's 6.7% return on your cash collateral per month. That is absolutely great. Of course, the risk here is a little bit bigger, since you do have to have the cash collateral just in case you get assigned and you wanted to purchase the stocks. But you can also roll it over to the downside if the stock went south and went down a little bit, as long as it doesn't go down all the way to 150. You can change the date for a short period of time and see how much you can collect from different strikes, like selling the 180, buying the 160, or something like that. The second stocks on our list is Coinbase. Take the symbol coin. Currently, I have two options on coin. As you can see here, I have two sell for 200 cash secure put, and I have one buy 135, meaning one of them is a cash secure put while the other one is a put credit spread between the 135 and 200. And as you can see, I have a cash collateral here of 26,500. I have a total unrealized gain of 57% right now, or 968. Let me open the 200 put credit spread quickly, show you the details of my trade. As you can see, I open on 624, it's -2, and this is the average credit. This is the unrealized return right now with the 970 unrealized gain, and there is a $760 left. So if I scroll down here and show you the details, as you can see, I open one credit spread. It gets fulfilled on June 24 at 7:39 a.m. During that day, the stocks did dip very hard, so I went ahead and during the same day opened a second cash secure put on it for $1,050, and that was in the same day as you can see here, but at 10:12 a.m. So with this one, I really got lucky. I sold this at the absolute maximum premium for coin at that day. So the average between the two of them will be the 8.65. And then after that, I wanted to reduce my cash collateral for this position. So I went ahead and I bought one of the puts on the 135. I went and I bought it on June 25th. This is how much I paid for it. And if I scroll down, this is the details for that trade. Let's go ahead and open coin options. So if we went here, let's go for the same date, like August 16. Let's change it to put and a sell. You will see here all the different strikes that we can sell or we can play on coin. Again, thanks to the high implied volatility, we have an amazing premium to collect from selling these cash secure put or the put credit spread. So if we brought the calculator again and we said 1170 divided on the 200, and that will result in 5.85 for just a month and a half. So if we divide that, it will result in 3.9% return per month, which is absolutely amazing. Again, similar to Tesla, if we went down to a lower strike, we will have bigger protection to the downside while collecting a smaller premium or smaller return per month. So in this case, the 698 divided on the 185, it will result in 3.7% return for the month and a half. We divided on 1.5, it will become 2.5 per month. Again, absolutely amazing. It's a very big return on our cash. So the 185 will generate a 2.5 monthly return, while the 200 will generate a 3.9% monthly return. And for the obvious reason, you take more risk, you get more return. Let's say we want to take the 185 for bigger protection to the downside, but at the same time, we can change it from being a cash secure put to a put credit spread by buying something like the 160 or the 150. So here, if we sold the 185 put and then we bought the 150, it will result in a credit of 536 per contract. So we'll bring back the calculation. 536 divided on the 35 cash collateral. So if we took the 536 credit premium that we are receiving divided on the cash collateral of the $35 per share, that will result in 15.3% return for the month and a half. You divide it on 1.5, it will become 10% return per month. Absolutely amazing. As you can see, using put credit spread, you are tying a smaller amount of credit and that will generate a bigger return since you no longer need 18,500 to open this cash secure put. Instead, all you need is a cash collateral of 3,500, as you can see here. And even this, in reality, you are receiving 500 right away. So in reality, you're really just risking $3,000. So your return will be bigger if you divided the credit on the actual cash collateral that you are keeping there. Again, you can take different dates with whatever you feel comfortable with to sell this cash secure put or put credit spread for the second half of 2024 to generate a higher return. Let me show you an example of how to roll over a put if the stocks went against you. So we went back here to the closest date, which is July 5th. And let's say we have an obligation to buy the share for 230 while the current price is 221. So we will buy to close the 230 for $10.98 per share. And then we will simultaneously go and sell something further in date. Let's go to the August 16 again. And we want to choose similar strike or lower to reduce our risk. In this case, I would love to reduce my risk by going to the 220. And if you went and sold the 220, you are actually going to collect 977 per contract, while simultaneously reducing your obligation from buying the share for 230 down to 220. If you expect a bigger movement in the price, possibly to the downside, you can go ahead and sell the 210. You are still going to collect about $500 per contract while reducing your risk $20 per share, which is absolutely great. And finally, you do have the option to roll it all the way down to 200. You are basically going to collect only a few dollars, which is in this case like $72 per contract. However, you are reducing your risk significantly from 230 to 200. And remember, this is a scenario where the stock went against you, like you are at disadvantage, and we are still able to roll over for a credit, even if it's tiny, and we are reducing the obligation against us big time. The third name on our list is PLTR. Palantir Technology has been one of the AI name play to do for 2024. If we scroll down, you will see my option positions. I have a 9 options strategies open on it. Palantir is the biggest cash collateral in my account at the moment. As you can see, I have a $45,000 cash collateral on Palantir. It's because I'm very bullish on Palantir and it has really amazing premium to collect while selling cash secure put and put credit spread that are relatively safe or safer compared to that return. Like the risk reward on Palantir, I really like it. If we scroll down here, you will see I have a few calls on it. One at 26 and the other four is for $30 strike that expiring January of next year. Let's take a look at my puts. These are the similar to the puts that I would recommend opening on it. The $20 put that expire in month and a half and the $18. There's also some $18 puts. It's actually 10 contract that expire on October 18. It has been positive so far. Let me show you quickly on the details here. You can pause the video and take a deeper look if you want. You can see here the date I opened them, the premium that I collected. And when the stocks went against me and the option went up, I actually average up by selling a new other cash secure put with a higher credit, as you can see here. Let's take a look at the 18. You can see the current price, the dates open, the unrealized profit, the status for it. And if I press on the history, you can see the full details here for the trade. So let's go ahead and open Palantir options. When opening any new position, I always like to start with selling a put or selling put credit spread. That's how I get a better entry price for the stocks. And if the stocks stayed above my price, then I will collect the credit for it without actually owning the stock, and then basically just repeating the process either on the same stock or a different stock, depending on what's going on else in the stock market. So in this case, if we went to August 16, you're going to see that I like August 16 for a reason, because all these companies announce earning before this date. So it has the additional implied volatility for the earning call, because possibly it will go up high or lower high. You know how it goes around earning. So if we went down and we looked at the $20 put, right now it's only have a delta of 10. When I opened it, it was much higher, and that's why I collected much more premium. As of right now, like selling this will not generate good return since it's really deep in the money. It's only 10 delta, which means 10% chance of getting assigned. For the 22 strike, you will see the delta is 21, so that's interesting to me. And then if we look, there is no delta of 30. There is a 34 and there's 27 for the $23 and $24. So basically, based on what your tolerant is, you will sell one of them for this date and you will collect a very decent return. I will also recommend, like, possibly you can just sell the $22 and take the 21 delta and then simultaneously buying something like the 18. That will limit your put credit spread to the difference between 22 and 18, which is $4 per share or 400 per contract. And since you are receiving a 56, in this case, if you bring the calculator and you say $55 divided on the 400 multiplied by 100, that's 13% 0.75 in a month and a half, divided on month and a half, that's 19.60 monthly return. Of course, as you can see in all our example, using a put credit spread will limit the cash collateral, and that will make the monthly return jump up the roof, like it's really high. However, it doesn't mean that I'm going to use all the cash collateral to open as much as I can, because if the stock went down, I will have to be able to either get assigned or roll it over. So I have to be careful with that. Similar to the other stocks, you are able to change the date and either experiment with selling either cash secure put or put credit spread and generating different return on different dates. And I'll leave that to you. I'll not dig into the details. Let's go ahead and jump to the next stock, which is going to be Robinhood with the simple HOOD. Robinhood right now is at 22.83. If we scroll down, you will see my position is currently small. So I'm trying to add more shares by selling more puts on it. Currently, I have a 3 strategy on it. I have a 7,500 cash collateral on Robinhood with the 2 cover call on the 200 share that I have. I have a 5 cash secure put on it for $15. This position is currently positive, and I also have a poor man cover call on it. You see the poor man cover call I'm buying for 15 and I'm selling for 22. You can see the dates here and you can see the full details for the trade. Let's go ahead and take a look at the $15 cash secure put. This is the date it's open, for expiration, the credit that I collected, and the total return. And here are the full detail about the trade. If we went ahead and went to Robinhood options, let's change it from call to a put. Let's change it to sell first. Let's go ahead and choose the August 16 again, the 47 date until expiration. So here you have to choose between selling the $21 and selling the 20. Each one has a different credit and different risk. You have a protection 13.84 to the downside. On the $20, you will have a bigger protection of minus 16. Even the $20 with the delta of 25, if you sell for a month and a half, you will get $100 per contract. Easy month. If you divide it on 20, that's 5%. And then you divide it on 1.5, it will result in 3.33 monthly return. Again, absolutely amazing. There's a reason why I'm choosing all these options to play for the second half of the year. They all have high implied volatility. While in my humble opinion, these are quality companies, and if I get to buy them at these prices, then it's a good deal for me. I can either go ahead and sell a cover call on them, or if I wanted to, I can just, instead of getting a sign, I will roll it over to a lower strike or possibly the same strike while collecting more premium over time. One more time, if you wanted to increase your return on these stocks, you will be able to change the cash secure put into put credit spread. The final name on the list is NVIDIA. If we want to trade NVIDIA's option, we want to sell a put on NVIDIA, let's go something similar for August 16, which is 47 days to expiration. If we scroll down to the 115 strike, you will see this has a delta of 30 and it can pay 4.75 credits. So if we divided the 475 divided on the 115, that will result in 4.13. Divide that on 1.5. This will generate 2.7 monthly return on your cash collateral. Again, it's very great return. That's thanks to the high implied volatility we have here. Alternatively, if you want to generate a higher return while taking a smaller risk, I will recommend going down to something like the 22 delta and selling the $110 put, while at the same time buy something like the $100 to limit your cash collateral. So in this case, we are going to receive $189 for risking just 1,000. So if you did a quick math, 189 divided on 1,000, multiply that by 100, that will result in 18.9% return on your cash collateral for a month and a half, or 12.6 monthly return. Again, you are generating, in this case, a higher monthly return while taking a relatively smaller risk, since you are only risking 1,000 to the downside. So that was all for today's video. I hope you like the 5 names that we gave to play stocks option on it. Please let me know in the comment, what name do you like to play for the second half of the year? And do you like to start any new position by selling cash secure put credit spread, or you have a different strategy? I would love to hear from you. Please, if you like this video, leave a like, subscribe to the channel. As always, the information provided in this video is for educational purpose only and should not be constructed as a financial advice. Investing involves risk, including the potential loss of principal. Thank you guys. See you in the next video.